There is a question that almost every person who opens a brokerage account for the first time eventually asks themselves. Not out loud, but quietly, in the back of their mind, usually around 2 in the morning after watching one too many finance videos. Am I doing this right? 3 men are about to give you 3 very different answers to that question. And only one of them is going to be right. Meet Marcus. He is 30 years old. He earns a solid salary. He has got ambition, discipline, and a real hunger to build something. Every morning before work, he opens his trading app. He reads the charts the way other people read the news, scanning for signals, hunting for patterns, watching the price action with the kind of focused attention most people reserve for things that actually matter. He buys and sells the same position sometimes twice in a single day. To Marcus, the market is a puzzle, and he is convinced, genuinely, deeply convinced, that he is smart enough to solve it. Then there is Daniel. He is also 30. Same salary. Same starting point. Daniel read somewhere that boring is beautiful in investing, and he took that seriously. He does not trade. He does not follow charts. Every single month, without drama, without ceremony, he buys into a low-cost S&P 500 index fund. The entire economy, packaged into one purchase. He does not think about it for the rest of the month. He barely thinks about it at all. And then there is James. James has a different philosophy entirely. He does not want to trade the market, and he does not want to own all of it. He wants to own the part of it that pays him back, directly, reliably, and in cash. James is a dividend investor. He builds a portfolio of high-quality companies with long histories of paying and growing their dividends. He reinvests every payment. He adds to his positions every month. And he waits, with the patience of someone who understands exactly how this game is won. All 3 men are putting $1,000 into the market every single month. Same money. Same starting age. Same 30-year runway. The only thing that differs is the decision they make about what to do with it. 30 years from now, one of these 3 men will be wealthy beyond what most people in their country ever achieve. One will be comfortable, but carrying a quiet weight of regret. And one will arrive at 60 with a number that is, honestly, hard to look at. Here is the story of all 3. For the first few years, Marcus looks untouchable. He has got stories. He has got screenshots. He had a week in March where he was up 11% while the broader market was flat. He called his position perfectly on an earnings report. He was in and out of a volatile tech stock before most people even knew the trade existed. At dinner parties, Marcus is the most interesting person to talk to about money. Daniel has nothing to say. I bought the index again is not a story. And James quietly talks about reinvesting dividends, which makes most people's eyes glaze over within 30 seconds. On the surface, for those first 2 or 3 years, Marcus is winning. But surface-level scoreboards have a way of hiding the real game. And the real game has already started, just not where Marcus is looking. Every trade Marcus closes, every single one, is a taxable event. When you hold an asset for less than a year and sell at a profit, that profit is taxed as ordinary income. Not at the favorable long-term capital gains rate. As ordinary income. The same rate as his paycheck. So every great call Marcus makes, every position he nails, roughly a fifth of that gain disappears before it can ever compound into the next trade. He does not feel it acutely. It arrives in April, spread across dozens of transactions, diluted into a form that is easy to rationalize. But the math does not care about rationalization. It just runs, quietly, against him. And there is a tax trap hidden even deeper, one that most active traders do not discover until they are already inside it. It is called the wash sale rule. If Marcus sells a position at a loss and then buys back into the same stock within 30 days, the tax authority disallows that loss entirely. It sounds like a minor technicality, but for someone making hundreds of trades a year, trading the same names repeatedly, it has a way of stacking up. The scenario that catches traders completely off guard is this: a year where Marcus's profit and loss statement looks roughly flat, not a great year, not a disaster, but his actual taxable income, because of disallowed losses, reflects a significant gain. He owes taxes on money he did not really make. The bill arrives in April. The losses are gone. And the account balance tells a story that the tax return quietly contradicts. Then there is the friction, the cost no screenshot ever captures. Every trade carries a spread between the buy price and the fill price. Every large order nudges the market slightly before it is completed. Individually, these amounts are invisible. But Marcus does not make one trade a year. He turns his whole account over many times annually, and even at a fraction of a % per round trip, that adds up to a meaningful and permanent drag on performance before he has made a single dollar of profit. And underneath all of it, there is what the data actually says. Not opinion. Not commentary. The kind of academic research that tracks hundreds of thousands of real traders over full decades. The conclusion, replicated across countries and markets, is consistent and unforgiving. The most active traders underperform a simple index by roughly 6.5 percentage points every year. Not in a bad year. Every year. 6.5 points, compounded over 30 years, is not a gap. It is a different life. What makes this number even harder to sit with is this: that underperformance is not evenly distributed across all traders. The top 1%, a genuine, tiny fraction of people who trade for a living, do earn consistent profits after costs. They exist. But here is the detail the trading industry never advertises. Research shows that roughly 74% of all-day trading volume is generated by traders with no history of success whatsoever. The market that Marcus is trying to beat is largely made up of other people just like him, almost all of whom are also losing. But here is the detail the trading industry never advertises. Research shows that roughly 74% of all-day trading volume is generated by traders with no history of success whatsoever. The market that Marcus is trying to beat is largely made up of other people just like him, almost all of whom are also losing. Daniel's early years are, frankly, boring. His account ticks up. It dips when the market dips. It recovers when the market recovers. There is nothing to say. There is no story. But something is happening beneath the surface that does not announce itself, it just accumulates. Every month, Daniel's $1,000 buys fractional ownership in hundreds of the largest companies in the world. Some of those companies are growing explosively. Some are steady and dull. Together, they represent the combined output of the most productive economy in human history. And Daniel is along for the ride, at near zero cost, without ever having to make a single prediction about what happens next. There is a counterintuitive mathematical truth at the heart of what Daniel is doing that most people never quite absorb. John Bogle, the man who invented the index fund and spent his life explaining why it worked, called it the relentless rules of humble arithmetic. The idea is this: by not attempting to outperform the market, Daniel mathematically ends up above average. Not because he is lucky, and not because index funds are magic. But because every dollar that does not go to fees, every gain that does not get taxed this April, every decision that does not require a prediction, all of it stays in the account, compounds quietly, and over 30 years produces a result that the vast majority of active strategies simply cannot match. Passive investing is not a compromise. It is an exploit. His tax bill is almost non-existent. He does not sell. He does not trigger gains. His money compounds in a protected, untouched state, growing not just on the principal he contributes, but on the gains he has never handed over to the government. That deferred tax is not a small thing. Over decades, it becomes an enormous thing. Money that would have gone to the tax authorities stays in the account, compounds, and earns returns of its own. It is the most underrated force in long-term investing, and Daniel barely had to think about it. But the most powerful thing Daniel has is not the low costs or even the tax advantage. It is something harder to quantify: he is always in the market. And being always in the market turns out to be the most structurally important thing any investor can do. Because here is a fact that almost nobody internalizes until they have lived through a crash. Over the past 30 years, missing just the 10 best days in the stock market would have cut your returns roughly in half. Not by 10%. In half. And missing the 30 best days would have erased 84% of your gains entirely. Those 10 days do not announce themselves. They do not come with a warning. And the research reveals something that makes this even harder to navigate. The majority of the market's best days happen during bear markets, right in the middle of the stretches when everything looks most terrifying, when the headlines are worst, and when the urge to step aside feels most rational. The second best day in 2020 came the day after the second worst day of the year. In 2015, the best single day of the year arrived 2 trading days after the worst. The market's biggest rewards are buried inside its most frightening moments, and the only investors who collect them are the ones who never left. Daniel never leaves. Not because he is brave, but because he automated the decision and then stopped looking. James, meanwhile, is doing something that feels almost old-fashioned by comparison. He has built a portfolio of companies that have been paying dividends for 20, 30, 40 years without interruption. Utilities, consumer staples, healthcare. Some of these companies have raised their dividends every single year for a quarter century or more, through recessions, through financial crises, through wars and pandemics and market crashes. To be included in that category of companies, known as dividend aristocrats, a business has to have done something genuinely rare: compound shareholder wealth consistently, in every kind of economic weather, for decades at a stretch. Not 1 in 100 companies can make that claim. Every quarter, these companies deposit cash directly into James's account. Every quarter, James uses that cash to buy more shares. Slowly, quietly, he is building what dividend investors call a snowball, a pool of capital that generates income, which generates more capital, which generates more income. The psychological dimension of this matters more than most people admit. And there is actually a Nobel Prize-winning explanation for why. In 2017, the economist Richard Thaler won the Nobel Prize in Economics in part for his research on what he called mental accounting, the human tendency to treat money differently depending on where it comes from. In traditional finance theory, a dividend and the equivalent capital gain are mathematically identical. 2 Nobel laureates, Modigliani and Miller, built famous careers arguing that it should not matter whether a company pays you dividends or reinvests those earnings, because the total return should be the same. And mathematically, in a frictionless world with perfectly rational investors, they were probably right. But here is the problem with that theory: humans are not frictionless, and they are not perfectly rational. When a dividend arrives in James's account, it does not feel like his portfolio shrinking to pay him. It feels like income, like something the market gave him, rather than something he had to take by selling. When he stops working 30 years from now, and a paycheck no longer arrives every 2 weeks, those quarterly payments will step directly into the psychological role that his salary once filled. Research consistently shows that retirees who try to manufacture their own income by periodically selling shares struggle to do it, not because the math is wrong, but because selling feels like spending down savings, while receiving dividends feels like being paid. The distinction is irrational. It is also deeply, stubbornly real. When markets fall, the day trader panics or freezes. When markets fall, the index investor watches their number shrink and fights the urge to do something. When markets fall, the dividend investor gets a pay raise in relative terms. The same income now buys more shares at lower prices. The strategy has a natural emotional shock absorber built into it. Historically, in the years when the broader market has declined sharply, dividend-focused portfolios have tended to fall meaningfully less. In 2008, the worst market year in a generation, the S&P 500 dropped 38%. The group of companies with 25 or more years of consecutive dividend increases dropped 22%. That gap is not just a number. It is the difference between staying invested and making a panic decision that locks in the losses permanently. By year 5, the gap has begun to open, but barely. Marcus's account has grown to something in the range of $65,000. He has done well by almost any normal person's definition. Daniel is sitting around 75,000. And James is close, around 70,000, with a portfolio that is now generating roughly $200 per month in dividends, automatically reinvested. Marcus still has the best stories. The gap feels like noise. But something has been quietly happening inside Marcus's trading that he has not fully reckoned with yet. He keeps coming back. Not just because it is profitable, but because the activity itself has become its own reward. Research on trading behavior reveals something striking about this. Profitable traders have a roughly 96% chance of trading again in the following 12 months. But unprofitable traders have a 95% chance of doing exactly the same thing. 1% separates the winners from the losers when it comes to the decision to keep going. Performance barely registers as a factor. The pull of the market is not about results, it is about the feeling of participation. And that feeling, for Marcus, is costing him more each year than he realizes. By year 10, the lines have separated. Marcus is at around $130,000. Daniel is at roughly $190,000. James is at around $165,000, with a dividend income stream now generating nearly $400 a month. Marcus is now $60,000 behind the man who never opened the app. He has no idea because he is still measuring himself against last month, not against a 30-year outcome. Here is the thing about year 10 that matters: James's portfolio no longer requires anything to go right. The income it generates arrives independent of what the market does next week or next month. It does not require Marcus to be correct about anything. It does not depend on Daniel making a prediction. It just comes from companies that have been sending checks to their shareholders through every crisis the last 30 years produced. That reliability has a value that compound interest calculators do not fully capture. By year 15, Marcus is beginning to feel it. Not in any single moment. Not because of any single trade that went wrong. It is something subtler, a growing awareness that the scoreboard he has been checking for 15 years does not reconcile cleanly with what the account actually holds. He has worked at this. He has been disciplined, focused, present. And Daniel, the man who bought an index fund and closed the app, is sitting on something like $370,000. Marcus is at around $220,000. $150,000 of gap. At the halfway point, James is at around $280,000, with dividend income now approaching $700 a month and growing. What Marcus cannot see from inside his own story is a pattern that the behavioral finance literature has documented with remarkable consistency: traders systematically sell their winners too early and hold their losers too long. The research shows traders exit winning positions at roughly 50% the rate they exit losing ones. They lock in small gains and ride small losses downward, convinced that the loss will recover. Across thousands of trades over 15 years, that bias does not average out. It compounds in the wrong direction. Every single year. By year 20, what was once a gap has become a chasm. Daniel is at $650,000, index investing, compounding untouched, tax-deferred, brutally simple. James is at around $520,000, with his dividend portfolio generating nearly $1,400 per month in passive income. Marcus is at around $310,000. He has spent 20 years watching markets. He has made thousands of trades. He has learned more about technical analysis than 95% of retail investors will ever know. And he is sitting on less than half of what Daniel has built by doing almost nothing. This is the moment, if it ever comes, when a day trader has to face the real cost of their strategy. Not the bad trades. Not the taxes paid in any given year. The cumulative, compounded cost of being active in a market that does not reward activity. The market does not care how hard you work. It does not pay for effort. And the painful irony of Marcus's story is that the skill and discipline and intelligence he brought to trading are the exact same qualities that would have made him phenomenally wealthy if he had simply directed them toward patience. Now, there is a version of this story that the dividend investing community sometimes tells where James wins outright. And it is worth being honest about why that version does not quite hold here. and also why it does not need to, for James to have made the right call. The structural reality is that Daniel's index fund carries a significant advantage that most dividend portfolios find difficult to overcome. It automatically captures the entire market, including the companies that grow fastest. In recent years, as technology companies have come to dominate the market's returns, a dividend-focused portfolio has tended to lag, not because it was poorly constructed, but because the highest growth companies often pay no dividend at all. James's portfolio does not contain them. He chose stability and income over maximum growth, and in the growth years, that choice has a visible cost. But here is what James has that Daniel does not, and it matters more than any spreadsheet can fully express. By year 20, James has an income. A real, growing, reliable income from his investments that is completely independent of whether the market is up or down. Daniel's wealth is real, it is substantial, it is impressive, but it lives inside a number on a screen. To spend it, he has to sell shares. At the right time, hopefully. At a price that reflects the value he has accumulated, hopefully. James does not have to hope. His income simply arrives. And in retirement, the distinction between a number on a screen and a payment that hits your account every quarter becomes one of the most consequential financial differences a person can experience. At year 25, James's dividend income crosses $2,000 per month. His portfolio is worth around $750,000. Daniel is approaching $1 million. Marcus has crossed 500,000, still a meaningful number, still better than the outcome most active traders actually produce, but achieved at a cost in time, tax, and friction that the number itself cannot communicate. 30 years in. All three men are 60 years old. All three have invested exactly the same amount of money, $1,000 a month for 360 months. $360,000 of their own capital, every cent the same. Here is where they land. Marcus, the day trader who spent 30 years working at this, ends with approximately $520,000. By now he knows he was one of the better ones. The data is clear that most active traders do not reach this number. Many never turn a consistent profit. Marcus made money. He just did not make anything close to what the alternatives quietly produced while he was busy. James, the dividend investor who built a portfolio of reliable income-paying companies, ends with approximately $900,000 in total portfolio value, and a dividend income stream generating around $2,500 per month. That income will continue to grow after he stops working, independent of market conditions. For James, retirement is not a date on which he begins drawing from a finite pool. It is a transition to living on income that the market simply pays him, the way it has every quarter for 30 years. Daniel, the man who bought one index fund every month and closed the app, ends with approximately $1.7 million. $1.7 million. Built from the same monthly contribution as the other two. Built without a single prediction. Without a single chart. Without a single hour of research. Built by doing almost nothing, with exceptional consistency, for 30 years. The gap between Daniel and Marcus is over $1 million. The gap between them in time spent on investing is, conservatively, 55,000 hours. Let that sit for a moment. There is a study that Fidelity conducted, an internal review of which client accounts had performed best over a decade, that surfaced a finding so counterintuitive it became one of the most cited pieces of investing lore in existence. The best-performing accounts in the entire firm belonged to investors who were either dead or who had simply forgotten they had accounts. Not the most sophisticated traders. Not the most well-read. The ones who could not act. It sounds like an anecdote. But it is a precise illustration of something the academic literature has been saying for decades. In investing, the less you do, the more you tend to keep. 55,000 hours. That is not a hobby. That is a second career, a full second professional life, worked in parallel to his actual job, for 30 years, that produced a result more than $1 million worse than the strategy that required 3 weeks of total effort. So what do you do with this? If you are Marcus, and many people watching this will recognize themselves in Marcus, the answer is not self-recrimination. The answer is recalibration. The urge to act, to hunt for an edge, to feel like you are doing something, that is not a character flaw. It is a deeply human response to uncertainty. The market is uncomfortable to watch passively. Doing something feels like taking control. But in investing, the illusion of control is often the most expensive luxury you can buy. One more thing worth knowing about Marcus's situation, and it is something the trading industry will never tell you: the addiction to the activity is almost completely independent of whether it is working. Research on trader behavior shows that profitable and unprofitable traders return to the market at almost identical rates. Roughly 95 to 96% of both groups are back within 12 months, regardless of results. There are traders with decade-long losing records who have never seriously considered stopping. The pull is not profit. The practical answer: if the itch is real, trade small. 5% of your portfolio, maximum, money you could lose without altering your retirement. Let that be your arena. Keep the rest in index funds where the math works quietly in your favor every single day. And if you trade, do it inside a tax-advantaged account where the annual gains do not trigger a bill that eats the compounding before it can run. If you are drawn to James's philosophy, to owning companies that pay you directly, to building an income stream rather than a pile of capital, that impulse is legitimate and, for the right kind of person, it may be the superior choice. Not because the total return is higher. It probably is not, over a long growth cycle. But because the shape of the wealth is different. Because income that arrives without requiring a sale is psychologically and practically different from capital that requires you to time your withdrawals correctly. Because the downside protection in a crash year is not just about numbers, it is about whether you stay in your seat when everything looks wrong. The honest caveat for James's path: it requires genuine judgment about which companies deserve to be in the portfolio. It requires reinvesting consistently through years when the price of everything you own is falling. And it requires an acceptance that in the years when growth stocks lead the market, you will be watching from a distance. The dividend aristocrats, those companies with 25 or more consecutive years of increasing payments, have historically delivered returns close to the broader index, but with meaningfully less volatility. That trade-off is right for some investors. For others, it is not. The key is knowing which kind of investor you actually are, not which kind you imagine yourself to be when markets are calm. And if you are Daniel, if the simplest path is the one that resonates, understand what you are actually doing. This is not passivity. This is not indifference. This is the most counterintuitive form of financial discipline, staying fully invested through every crash, every correction, every moment when the headlines make holding feel like a mistake. Knowing that the market's best days arrive inside its worst stretches, and choosing to be there regardless. Knowing that by not trying to win, you end up above average. And doing it for 30 years while everyone around you has a better story to tell. That is not laziness. That is mastery in its most underrated form. The market does not pay you for complexity. It does not pay you for effort. It pays, with extraordinary generosity, to those patient enough to wait, for time. $1,000 a month. 30 years. $360,000 invested. 1.7 million returned. The question was never, am I doing this right? The question was always, am I doing this long enough? Disclaimer. The content provided on this channel is for informational, educational and entertainment purposes only and does not constitute financial, investment, legal or tax advice. All opinions, analyses and statements expressed are based on personal experience, personal research and publicly available information and are subject to change without notice. No guarantee is made regarding the accuracy, completeness or reliability of any information presented. Investing in stocks, cryptocurrencies, ETFs or any other financial instruments involves substantial risk and may result in the partial or complete loss of capital. Past performance does not guarantee future results. Nothing on this channel should be interpreted as a recommendation, solicitation or endorsement to buy or sell any securities or financial products. All investment decisions are made solely at your own risk and responsibility. Viewers should conduct their own independent research and consult with a licensed financial advisor, tax professional or legal advisor before making any financial decisions. The creator of this channel assumes no liability for any financial losses, damages or other consequences arising directly or indirectly from the use of the information provided in this content.